fine Tuesday, halfway through January. Had a little bit of snow. Now we're back to normal grey skies, murky days. Service resumed. What's going on in the markets? Well, I better do a quick sound check. Give me a shout if you can hear me. It looks good. The little dial's moving. You can see my face. You can see the screen. I think we're good to go. Markets just doesn't know what to do at the moment. Nasdaq up, down, left, right, back down now. Will it close at VWAP by the time we finish this? Maybe it will. Let's have a look. Evening. Thank you, Richard, for that. We'll get started in a moment. So what's going on? I'm not going to share the screens. There's a lot to cover today, and I want to make sure that we get it all in time and answer your questions later on as well. We've got opportunity to. So I'm looking at my other screen here. Dollar yen's probably the most interesting breakout we've had. Bitcoin's trying, of course. It feels like a broken record. Silver continues to go to new highs. Gold, not quite, but well, it was yesterday. But silver's just absolutely ripping, isn't it? It's incredible to watch these little pullbacks and just continue. You know, at the end of the day, we're talking about mean reversion today, but the trend is definitely something to. The trend is your friend, except the bend at the end. Is it easy to spot the bend at the end? No, it's not. But you know, it's interesting when you get a real reprice scenario and stuff just keeps going and going and goes crazy. I'm just shuffling around some bits and pieces here. I've got a gold charts printed out, all sorts, scattered all over my mucky desk. Fortunately, you can't see that. I should have us cleared. I've actually got this book which I'm into at the moment, Daily Stoic. Had the audio version for a while, but it kind of makes sense because you can read a page each day. Here's an interesting thing, and I've highlighted. If you seek to avoid all disruptions to tranquility, other people, external events, stress, you will never be successful. I think that's perfect in trading. You have to be aware that you will always get stopped out. You will always miss a fill. You will always make an error, and you can't allow yourself to be frustrated by that. You have to just accept it, move on, and stick to the process and understand that it all work out in the wash eventually. All right, so I think tomorrow the Supreme Court are going to rule on the tariffs. I think they were supposed to do it last Friday. I don't think they're going to do it tomorrow now. Who knows? I believe the odds that they're going to state the tariffs are illegal. This is Donald Trump's tariffs, by the way. But he's got other legal routes to go down. I mean, I try not to get too much into the thick of stuff. I just want to watch price action. There's a few things I'm going to watch, like Nike, specifically Caterpillar, things like that, how the market responds, how dollar responds. And let's just see the vibe. It's too easy to second guess this stuff and then be wrong footed. So let's see what happens. Okay, let's get started. Thank you for joining me this evening. My name is Mark Holstead. If you haven't met me virtually before, some of you I've met, I've shaken your hand as well, but here we are virtual at the moment. Traded for a couple of decades plus. Not here to say this is exactly what you should do, but I'm always from a perspective of I've seen this to be effective, or I've seen other traders use this with decent efficacy, work with other traders as well as my own stuff. And so I kind of try to collect what I think is valuable and sort of give it to you. And I tend to, well, I don't tend to, I know, and I've seen this numerous times at the, you know, with other traders growing from developing phase and kind of making breakthroughs, is that you've got to make stuff your own. You know, I can sit here and say this is a really good strategy, it's been super effective, and look how well it's done, and show you all this type of stuff. But if you don't really feel it and you don't really, you know, like it, and it doesn't really fit around your personality, your lifestyle, this type of stuff, it's never going to work. So I like to think in terms of themes, in terms of not necessarily systems, automated systems, but models, and so ideas, so that you hopefully you take these ways of thinking about mean reversion today. Last time we talked about trend trading. Next week we're going to talk about traps and this type of stuff. And so that's your elevator pitch, if you like. I like to capture mean reversion, or I'm looking with this specific strategy to capture a trend day or a multi-day trend or whatever it might be. So you have your North Star of the type of trade or the type of trade you're trying to make. And then you fit in all the other stuff out there, the myriad of tools and price action patterns and indicators, if you like, you know, whatever you want to mold into the way that you like to trade. You know, I was having a discussion with a trader yesterday in which we were kind of working to, you know, he's very, very busy. He's got, you know, he's got a job, full-time job, he's got a family, and we're like, okay, we need to let's devise a strategy that works around you. And so over the last months, we've been kind of doing this last few hours of the trading day, and he's scanning for certain setups and strategies. The point is that, you know, he likes it and he feels comfortable with it. If you're watching, how you doing, pal? Because it fits in with who he is as a person, who he wants to be as a trader, and the actual resources he's got, the time he's got, the energy he's got. And so, you know, everything has got to fit like that. It's literally a personality fit and edge with the strategy. Those two must blend together. If there's a mismatch, it doesn't work. You have to have edge and you have to have this personality fit, because then discipline becomes easier, motivation becomes easier, it becomes more of a pleasure to journal. All this stuff that you maybe struggle with as a trader becomes easier when you get that, let's say, product market fit, but set up market fit, let's say strategy fit. And so very often I come from this approach of, listen, you know, I want to share with you different ideas, different ways of looking at things, different lens to look at the market through, and try and break it down into these chunks. And we're going through this 12-week traders operating system theme at the moment, so that I can give you as much as I think you need, and you then pick and choose and go, hopefully at the end of the 12 weeks, you go, that makes sense from a mindset perspective. That makes sense from a strategy. I'll have a little sprinkle of that, a little dab of that, a little squeeze of that. There's my traders operating system. Does that fit in with my lifestyle? Does that fit in my personality? Does that fit in with what I want to do and my future pacing of where I want to be as a trader, 6 months, 1 year, 6 year, couple of decades? And you go, yeah, it does. Right, here we go. Let's go full force ahead. Anyway, so today we're talking about mean reversion and compression models, a practical guide, no less, to trading overextended and range bound markets. We'll talk about the two different types of mean reversion in a moment. Great quote from Paul Tudor Jones here. This was a while ago. Obviously, he's a different trader now, hedge fund, etc. But he said this, and this stuck with me in my very early days, early 2000s. I thought, oh man, because it was the first Market Wizards book, I think this was from. And everyone's saying, trade with the trend, trade with the trend, trade with the trend, trade with the trend, trade with the trend. Yeah, I struggled to kind of buy the trend. I was thinking this at the time. Where do I buy it? And actually, you know, Paul Tudor Jones said, hey, I believe the very best money is made at market turns. Everyone says you get killed trying to pick tops and bottoms, and you make all your money playing the trend in the middle. Well, for 12 years, I've often been missing the meat in the middle, but I've made a lot of money at tops and bottoms. And I thought, I think that was the first time I was enlightened to say there's more than one way to trade. You know, last week we're talking about, you know, trends and jumping on trends, and, you know, the simplicity of kind of bracketing the pullbacks and, you know, letting the trend work with you and all that type of stuff. When we're talking about mean reversion and compression model, volatility compression models, is a different way of thinking, and it might suit you better, this, as opposed to, you know, I say blindly jumping on a trend, making the assumption and being fully committed to the fact that trend's going to continue. Because if you remember that webinar, that's got to be how you trend trade. You have to believe that this trend is going to continue indefinitely and be flooded with certainty for you not to get wicked out by the slightest little move. Think about the silver guys. You know, they've got to be fully committed that that thing is moving high, because it's well overbought, well overstretched, but it doesn't matter because it keeps going. You know, but if you're looking from a kind of a mean reversion perspective, you're like, whoa, I need to stay out of this. Anyway, so, and also Jason Shapiro does a lot of market turn type stuff. So there's a lot of great traders who specialize in market turns, and not necessarily broad market turns. We're going to look at intraday stuff as well. Don't worry, we're not going to go down to the 5 minute and look at the daily. But I thought it was interesting that, you know, PTJ, you know, openly says, hey, you know what, this is my edge. This is how I trade. I'm not trying to be a trend trader. I'm trying to time the turn, and I'm then devoting all my energy and resources into being the best trader I can be at that. And I write a daily email. Many of you are on that already. If you go to tradersmastermind.com, you can get that. You can also get the discipline tracker. But one of the things I'd said is, see so much greatness in traders when they put their flag in the ground and say, that's my North Star. That's the type of trader I am. That's the type of direction I'm heading. Right, let me put every resource into that. Every piece of content I consume aligns me with that. Every book I read aligns me with that. Every trade I take aligns me with that. Every journaling I do, etc. Anyway, going off on a tangent already. We haven't even started. Let me just go through the risk disclaimers with you, boys and girls. You know the score by now. Trading super risky, as you know. Leverage, margin, double-edged sword. When it works well, super duper. You're making money, you're leveraged up, very, very nice, but it can turn nasty quickly. So just please understand how spread bets work, CFDs work, and any other instrument that you're trading, and, you know, whether it's the right thing for you. If it's not, that's fine. No, you know, you don't get any prizes for going, yes, it's right for me, and it's not really. if it's right for you, honestly, take your time, understand the product you're trading, try a demo out. Pepperstone offers a demo, paper trade, do whatever you need to do to understand the risk, manage risk, of course, with size, with stops, understand gap risk, slippage, all the other good stuff that comes in it, headline risk, yada, yada, yada. Hopefully you are good with that. Good with that? All right, I'll make the assumption you are. Okay, so before we dive into the mechanics of this, I want to kind of remind ourselves that we something talked about last week. And the reason I say this, because I think it's so crucial. You know, I see so many traders just thinking differently about the setup. And I call this mindset matching. It's not a very fancy name. I admit I could do more work on it. But, you know, what we're trying to do here is we're trying to match the way we think about something to the trade. So last week I talked about trend trading. You know, if you're fully committed to the fact that trend's going to continue, every time it retraces, you don't see it as a threat. You don't visualize it as a threat, or perceive it, should I say, as a threat. You perceive it as a potential opportunity to base and go again, because a new base, a new high, new level of support is a new high watermark for the trend. You know, so your mindset has to be, how do I perceive price? Do I perceive it as opportunity or threat? How do I, when I'm future pacing, how I expect the trade to work out and the candles to, you know, eventually reveal themselves? What would that look like for the trade to be, the thesis to be correct? What would it look like for it to be wrong? So if we're looking at it from a kind of mean reversion perspective, and we'll do some definitions in a moment, don't worry, we're targeting A to B only. We're looking for a move back to the mean. That's our sole objective, right? We're a trader. We're saying, hey, we're trying to identify when we think there's an inefficiency in price, whether that's short term, medium term, you're probably not long term, but that inefficiency in price, and we're trying to get it back to efficiency. A great phrase that Don Miller used. So Don Miller, a blog I used to read, and I think it was the early 2000s or mid 2000s. He used to day trade the S&P 500. He would share his statistics and stuff, blah blah. You can go and check it out. I think it's Don Miller blogspot. Anyway, one of the things he said was he was very active trading the S&P, and he said, I like to buy at wholesale, sell at retail. And I thought, you know, that's such a good way of thinking about mean reversion. You know, if the market's extended in the right conditions, and we'll cover that, you know, you're kind of trying to get the best opportunity, selling at retail, buying back at wholesale, and buying at wholesale, selling, and that's the job. And the mindset has to be matched with the job that we're trying to do. So the strategy we're deploying is, I'm trying to capture these short-term inefficiencies. I'm not looking for home runs. As PTJ says, I'm looking for the turn. I'm not looking to capture the whole trend. And the same thing as well of being, you know, mindful about your stop losses, specifically mean reversion, because the dichotomy, if you like, of mean reversion is the further away the trade goes, the better it looks. And you can be in a situation where that looks even better for a pullback because it's actually better price, and really it's breaking out of a mean reversion environment and you're switching to a trending environment. Quick story, years ago, 2010, something like that, I don't know when it was, it doesn't matter. I went to Vegas and I met up with this trading firm, and one of the guys there, he massive account. He had other traders working there, and he used to trade pair trades on US equities, right? So he would do UPS, FedEx, they still trading if they're still listed, that type of thing, right? So he would pair trade stocks that were in the same, I suppose Uber, Lyft would be the same type of thing. He would look for the ratio of those pairs to move out of line, and then he would trade for it to mean revert. But he would add to the trade something like 3 times, and he'd have trades that were so offside, and eventually they'd come back. But the point is, he had such a large bankroll, it didn't matter. He was spread out, and his risk was spread out. But something he said was, you know, I have to be careful. I don't get into the trap of trying to be too aggressive. I've got a very structured way of scaling in when stuff goes against me, which I don't recommend that. But that was the way he traded. And one thing he said then was, actually, you know what, the trade sometimes can look better the further away they go, because I'm licking my lips about all the profit I could make when it comes back to the mean. So, you know, you can get into that mindset. So again, the mindset matching is, hey, it's my job. I've got a stop loss here. I'm not going to get seduced by a better entry for a mean reversion play, more my profit potential. I'm looking at this through a clear lens of, I'm targeting A to B, move back to the mean. If it breaks and I'm wrong, I'm out, I'm reviewing, I'm looking for the next sequence. The next play. Super important that. All right, let's define the mean. So, you know, there's no textbook stuff out there. Some people say, oh, it's the moving average on your Bollinger Band, or, you know, it's the VWAP. And they're fine. These are all valid. And it's up to you as a discretionary trader to make the judgment, where the hell is the mean? What does the mean mean for you? Every time I say mean drink today, that'll be, yeah, you won't make it till the end. You know, what does it actually mean? And so it can be, you have to make the judgment based on what you see in front of you. Let me give you an example. You know, when we were having these periods where the market was just kind of ripping, the tariff period, you know, the tariffs were coming on, we're just getting hammered to the downside. You get a massive flush, let's say on NQ, you could buy that flush for a pop back up. The mean was just a pop back up on a blooming 1 minute chart. That was how you were defining a mean in the very short term. If you were scalping, now that would be your mean. If you were trading, let's go back to this slide now. If you're trading, let's say, you know, an uptrend that really accelerates, you're looking for like a 1 day reversion. That could be a mean. Maybe if you're a technical trader, the mean is a pullback to a breakout point, and you're kind of selling into that strength and timing it and whatever you might choose to do. Maybe you're, you know, trading in a range bound market and it's just, you know, a flat VWAP or a flat moving average, or it's back to the opening print, or if you like to use floor trader pivots, maybe it's a pivot. But the point is, it's up to you. You define it before you take the trade, and the type of trader you are and what you're trying to achieve. And so don't force a moving average because that's the mean, or the middle of a Bollinger Band or a Keltner, which is a moving average, obviously, onto the trade. It's like, well, what does it mean? What's the market telling me? What are some chart examples in a moment? But it can vary from trade to trade, I think, is the point. Okay, so to the meat of this stuff. I think, again, I'm not claiming to be that I know I'm right here at all. This is the way that I approach it. It's been pretty effective, and I think this is a good way to look at stuff. So 2 distinct approaches for mean reversion. I think we have what's an overextended market, and this is when, and again, chart examples come in all sorts of stuff in a moment, so they'll make sense if it doesn't quite, you know, click at the moment. And I know we're waving our arms around and talking stuff. It's so much better when we can show a chart. But let me define this first. Version 1, overextended market. So a market that's just absolutely ripping on a daily chart, flying, and you think that there's maybe 1 day of reversion back to the mean. Maybe it's a 5 moving average. Maybe it's just an unwinding of some sorts. And you might be like, oh, that sounds dangerous. Of course, better trading is dangerous. We'll talk about how we kind of time that in a moment. The second version, which I think is the more textbook version, is a range bound market. Actually, today, NASDAQ, I'm looking at NASDAQ, that's been pretty mean reverting market, right? It's range bound. It's popped up to over 26,000 on the futures, pop back down, pop back up, pop back down. It's range bound. And so, you know, that's the classic mean reversion. And often you can define that by saying how flat is the mean, how flat is the VWAP, how flat is the moving average on the time frame I'm looking at. And you're looking for this sideways market, and it's a defined range, and you're trying to trade, you know, overextension, you know, discount, premium, this type of stuff. So I think of the 2 different approaches. Obviously, they require subtly different skill set, but you're ultimately looking for the same thing. You know, if we go back to what the mean actually is, then you're trying to say, this is what I think the mean is. I think this is overextended, or I think this is an inefficiency. I'm looking for it to now become efficient. That's really our North Star and our catch-all. All right, can we trade and find and identify an inefficiency on the short term, maybe it's a little bit medium term, and trade that inefficiency as it comes back to some sort of equilibrium, some sort of efficient pricing? Do we know for sure? Is there a big kind of sign waving going, I'm inefficient, buy me now because I'm going to bounce back tomorrow? Of course not. It'd be nice if there was. In fact, if there was, there wouldn't be any opportunity, would there? So maybe we're glad there isn't. But you get the idea. You know, we are a discretionary trader trying to identify that, trying to decipher when we believe there's a short-term price inefficiency. Okay, so version 1, the overextended markets. This might not suit you. I hold my hands up and say this may not suit you, but I found this to be a super effective way of, this is more the Paul Tudor Jones way, even though you can trade it on an intraday chart. So it's more aligned with what he was saying, but this time we're not looking for the kind of full reversal. We're looking for the spring to stretch, and then contract back. So stretch move on a daily chart, and you're playing for 1 day of mean reversion on an intraday basis. And I'm going to give you rules in a moment to the thief strategy, which was John Bollinger's strategy, which is very, very similar to this. So the whole extension on the daily chart, using that as your kind of reference point, the higher time frame, and then you're going to the intraday chart on your 5 minute, whatever it might be, and timing and aligning only with the side of mean reversion. So for every extended to the long side, and you identify that, you spot that, some ideas and way to do that in a moment. You're only the next day trading on the short side, whether you're trading, range breakout, whether you're scalping breakdowns, whatever it might be. And think of it as like the market's run and run and run and run, and it just needs to calm down. And it might, and again, back to the kind of what you're trying to achieve here in the mental model, or the mindset matching, the cool phrase, you're betting on some kind of relaxation, not a full reversal. You're not looking for, this is the top of the market and it's going to rotate down for the next quarter. That's not exactly what you're going to do. So yeah, you're trying to find this inefficiency on the higher time frame, and it's, as I say, it's not always a reversal. It's just that spring contracting again. Imagine a spring just stretching. At some point, it comes back. It could still stretch again, but we're kind of trading that oscillations. And the framework to have is not this overbought, it's gone too far. It's like, hey, this is inefficient and emotional, and there's some ways that we can kind of do this. Before we look at those, I wanted to just get this picture in your mind. I kind of did that, this kind of faux spring in the sky here. But think about this from a volatility, expansion, and compression. If we have price expanding, contracting, expanding, contracting, volatility expands as well. As we kind of start to stretch and start to really rip, volatility increases. And then what happens, a lot of people think that volatility crushes, and as the opportunity, we often have one more stretch, and that's the mean reversion. That's like, wow, we have a massive down day after these solid up days, and then it compresses. And a lot of traders, I think, go too late into it, and they wait for the compression rather than seeing the expansion, the real stretch. It'll make sense in a moment in a chart. I don't need to include that slide. Okay, so example that was a really, really fantastic intraday trading opportunity. It was one of the best of the quarter, I think, from a mean reversion perspective. Gold was ripping up, and if you're a trend trader, good for you. You caught that massive run. I'll give you a little golf clap. You probably are very pleased with yourself, and obviously it's run on even further, which is the point. We're not trying to trade, be a genius here and look for reversal. But there was a couple of days, the 21st, I think that was the 21st, was actually somewhat, funny enough, it's the thing that I printed out. Because I'm studying it a little bit more, because it was such a good day for that particular style. You've got a stretch market, really moves, got run 30%, runs an extra 10% in a thick market in the last kind of few days. And now you're kind of poised. Unless you're a trend trader and you're on this, you're like, hey, you're an intraday trader, you're a day trader, maybe you're a scalper. How can I use this daily time frame to guide me on my intraday stuff? And as it's starting to get more stretched and really absolutely rip into the high side, each day you're coming in going, man, if I see this, and I'll show you what we're looking for in a moment, I'm going to get short, and I'm going to really press it, because it's a mean reversion trade on a daily, and I think there's opportunity. And that's the mindset I think to have. When markets are ripping and you're not on them, you can soothe yourself by saying, well, you know what, I'm just going to come and see if I see weakness, and it's persistent weakness, I'm going to press the absolute out of it, because I know there's likely to be some kind of unwinding on the daily. And so you can use that higher time frame guidance for your day trading. So once we look at the higher time frame stuff and we see stuff that's really overextended, really stretched, right? We're not trying to be heroes, not trying to pick a top. We're looking now for additional clues. And so when we see a market that's really extended, it's kind of accelerated up, and you see with that gold was a great example. It just kind of kicked into another gear, huge ranges, huge volume, doing 10% in like a few days on something like gold. This is not sustainable. Now, sure, you don't know when, but at some point this is emotional now. We're getting emotional. So as a short-term trader who's trying to capitalize on an inefficiency, I would say this is getting pretty inefficient. Now that isn't perfect, because if you just have a stab at it, you get your face ripped off, right? We want to be smart, we want to be structured about how we trade this mean reversion play, but at the same time, we know this is going to create opportunity. And there's there's dozens of examples like this in specific markets. You know, didn't want to overload you with stuff. So once we've seen an overextended market, we now want to look for the intraday cues, because you may be a short-term trader. Even if you're holding for a few days, this still applies, but this is when we're really kind of being aggressive. We're getting aggressive with our entries. We're kind of pressing as hard as we can. We're adding to trades, maybe, if that's your thing. You know, we're taking advantage of the fact that this thing is so stretched and the rug has just gone boom, and everyone's just looked around and gone, whoa, there's no buyers, let's get out of here. So once we've identified the market is overextended and we go, this is the day, we're comfortable, now we start to look for real-time clues to validate that. And by the way, you may say, and this is absolutely fine, you know, your job as a trader is to find the high probability trading setups wherever they may occur. You may say to yourself, this looks good on a higher time frame, this looks good intraday, I want to take one trade which is X, but I've got so much weight and the likelihood of this working is so high, I'm just going to take this A to B trade and be done. So you don't have to be taking all of it, holding the whole move. So this was the intraday chart of that rollover 20, I don't want to mislead you, I'm pretty sure it was the 21st from memory. And look what happened. This plays out again and again and again, boys and girls. Honestly, it's such a beautiful chart when you get it. And obviously it doesn't happen very often, which is why we're going to cover other more frequent stuff. But 8 o'clock, UK Open, what's happened? There's just this huge amount of supply coming in, running it down. And then it just does that classic, just sitting at the bottom, just wondering what the hell to do. And then another leg lower. And then you've got 2:30 US Open, an attempted pop that just fails within 10 minutes, and then it's the rug pull. So, you know, let's look at this from a structured perspective. You've got these tiny little flags from and this is the important thing to look. I think trying to look at this too early on gives you a false sense of security. The volume's low in the market like this. You want to wait for the times when you know there's money flow, and we know there's money flow at 8 a.m. We know there's money flow at 2:30. We know there's oh, by the way, the 6:30 print is the settlement for COMEX Gold. So the official settlement for the options, for any other structured contracts, they settle at 6:30. It's 7:30 for crude. Obviously, it's 9 p.m. for equities. So it's worth thinking, okay, that's probably I'm done 6:30. I'm not going to kind of push my luck. So what are we looking for intraday? We've already seen the higher time frame stretch. We already think, could this be the day? No. Could this be a day? No. Could this be a day? Hang on a second. We have just been body slammed from the UK Open, and you've got these little tiny flags, big legs lower, all structurally very, very weak. And then you have the moving average catching up as price. It can't even lift above. I don't know if you see my cursor. I don't know if you can or you can't. You can't, on that last 5-minute candle about 9 a.m. to the downside, it spends 2 hours or whatever it is. It can't even break above the high of that. So now you can say, well, I want to short a breakdown. You know, do I want to short any fakes to the upside that we saw at the 2:30 p.m. US Open? There's so many ways of doing this, and you kind of know this, but the key isn't really how to structure this. And it does help, you know, you got the flags, you got the breakdowns, you got the fake outs, the highs, all good stuff. The key is it's a mean reversion play that's been guided by the higher time frame, now on the lower time frame. Even if you're a scalper that says, hey, I just want to grab these little pulses, breakouts to the downside. You know, it's already down low. You can see how you're adding the weight behind you. You're stacking these layers of edge, and the opportunity then just becomes so much weighted in your favor. Now, of course, you've got to manage your risk. Of course, you don't know if you're going to be right. Of course, you can be too heavy, you can oversize, you can make yourself vulnerable on this stuff. But, you know, it's that extended market that just gives you the intention and the aggression to trade it intraday. So some ways to qualify these overextended markets: unusual percentage move in something thick, extreme price action, a last kind of gap or a big wide range day, some signals of exhaustion. You've been trading for a while, you see it, and it's the daily time frame that gives you that overextended market. And then you're looking for those intraday clues that say, hey, we could mean revert, I want to trade that. Like I say, it's not something that happens all the time, but when it does, chef's kiss. Okay, Bollinger Steve strategy. So at Pepperstone Talks event, so we had one in London. How many years ago was this? Anyway, John Bollinger came to talk. I was speaking. I think that Greg Rosetsky was there as well. I wasn't talking about trading. I was talking about mindset and tennis. But anyway, so John Bollinger was there. He shared this Steve strategy. So it's not mine. It's John Bollinger's. He shared it at this event. So and he's happy for people to talk about it and share it, giving him full credit, of course. And me being the joker, I went, oh, you know, hey, John, do you use Keltner channels? It's like, you idiot. Amount of times he's probably heard that, and he's like, this absolute idiot. Thinks he's funny, Mr. John Bollinger. Anyway, this is Steve's strategy. I'll show you an example in a moment. There's a lot of text here, isn't there? Basically, you have your Bollinger set to the 22. And by the way, why I'm sharing this is a very methodical, systematic way to trade mean reversion. So if you look at the overextended idea and go, yeah, it's too subjective, I can't think I'd do that. This is very systematic. You can screen for this. Approved by Mr. Bollinger himself. Configure your Keltner channel. Yeah, bad joke, Mark. Configure your Bollinger bands to the standard 20 period, 2 standard deviation setting. You're basically looking for price to close above, in case of a short, the upper Bollinger band, and the next day close below, and those 2 ranges to be more than the 14 period ATR. If you see that, you trade in direction back to the mean. I'll show you an example in a moment. If you want to screenshot this, fine. You will also get a copy of the recording, and there's a lot of text on here, but those are the actual rules. Okay, example. We had one in the yen not long ago. You're looking for a close above the Bollinger band, and then you have to the close below the Bollinger band. Both of those ranges have got to be bigger, the daily range, than the 14-day ATR. So it's got to be volatility expansion still, because often you don't want to grind. Sometimes it grinds. So it's like, hey, inefficiency. We've closed above the Bollinger band. That's not necessarily efficiency on its own, and we get multiple closes above Bollingers. You know how price can sometimes hug the upper or lower Bolly, but you have that with a range exposed, or a larger range, a wider range than normal, should I say. Then you get the reversal, and the trigger point here is you take in this example, you take a short on the close of the candle that closed below the upper Bollinger band, a stop above that candle high, and a target of the mean or the moving average of the Bollinger band. Pretty wide stop on this one. Not a great example, but I'm not sitting there forever cherry picking stuff. There's loads out there. This is the kind of recent one on the market. That's pretty spicy at the moment. You'd take it on the close of that red candle, and then your stop will be above the candle, and your target will be the mean. Now, obviously, the RVR on that trade isn't going to win any awards. A Nasdaq, you wouldn't, on the first left-hand side, you wouldn't have got a signal there, because the range of the candle that closed above the Bollinger band isn't more than the 14 period ATR. So no signal, even though you got a candle close above followed by a candle close below. That was a wide range. It would have, but it didn't signal, because you have to have both those candles have to have a range above the 14 period ATR, which is on the first sub chart is your yellow histogram and the red line. Ignore the volume on the bottom. So the yellow histogram is the range of the day, and the red line is the 14 period ATR. So you can see this wouldn't have triggered in that moment. However, the long did trigger, because you've got the big red candle on the 19th of November, closed below the lower Bollinger band, and that's a big wide range day, so tick. The next day, the candle closed above the lower Bollinger band, the one where I've got the little green arrow on, and the range was just over the daily range of that candle was over the 14 period ATR. Tick, you're in. So according to John Bollinger's rules with the thief strategy, you're long on that candle close. What was that, 24,250-ish? Stop goes below the low of that candle, and then you're looking to hold back to the mean, the middle of the Bollinger band. Now, let me just say this. I'm not 100% sure if he says close after 2 days. I might have got holding to the mean wrong. His version of mean might be a 2-day move. So I'm not 100% sure on that, but that, I mean, does it matter? We can make a judgment yourself how to exit this type of thing. But you can see how that's a very similar type of approach, right? Is mean reversion. Where do I identify a stretch market? In the case of Mr. Bollinger there, he's saying, oh, well, I'm going to use my bands. Why wouldn't he? A close above. I want to see the volatility. You know, we talk about volatility expanding, contracting. He wants to see it still expanding, which is going to use the ATR over the 14 period as a judgment for that, as a filter. expansion, yeah, we still got it, and we have a close above, then we have a close below, because we don't want to be chasing just random highs. So I've seen the reversal, the volatility continues to expand. I'm expecting now mean reversion. So there's multiple ways of doing this, and again, how would you potentially trade this as a swing? I think I've got a slide on this. I'll come back to it if I haven't, of how we might trigger this. In fact, I'll talk about it now while it's in my mind. If we have a slide up, we'll skip it. So how you might trade this, you either just buy on the close in the case of here, or maybe the next day, if you're a day trader, you go, hey, the daily chart, daily time frame has guided me. I'm going to trade like an opening range breakout, 15-minute opening range breakout, but only to the long side the next day, because I believe, you know, the weight of the market now is suggesting that we're going to mean revert back to that moving average, or whatever, you know, or I'm going to trade intraday flags. So you can still tune it depending on how you like to trade as well. You have to just be a swing trader on this and hold trades overnight or hold trades for multiple days. You can use it as a rising tide or a falling tide as a way to say, okay, I'm only going to take longs now because the thief strategy's triggered. We almost got one on Costco. I didn't even update. This was yesterday. I don't even know what it's done. I thought I'd include it because it was setting up slightly. But I don't think it triggered. Not that it matters. I don't think it triggered. But you see, this is how you would screen for stuff. You would say, hang on, we're closed above the upper Bollinger Band. Yes, we've got a wide range. Yes. So this day, today or yesterday, I can't remember when I screenshotted this, you want to close below and it's still a wide range, and then you'd be targeting the mean. If it doesn't, you don't take it. So the rules are pretty strict. Another example here, I'm pushing the down arrow and it's moving my trading view. That's no good. Should move in the slides. Little one on Bitcoin. It ain't a huge one, but it's the same type of thing here. You had the close above, wide range day, and then you had the close below, wider range day or bigger range than typical, and then you exit the mean. This ain't going to win any awards, and maybe you wouldn't take it because the Bollinger Bands are so contracted, but you get the idea. Okay, so again, these aren't home runs. You're not looking for you know, a massive trend reversal. Perhaps you want to combine it with that, and that's fine. There's no reason you couldn't, but strictly speaking, these are, you're looking for that inefficiency. You're not trying to predict the turn. You get in, grab your piece like a good trader, get out before kind of things move out the way. So questions I'm kind of asking myself is just, you know, when I look at this type of thing, you know, is price still moving strong, or have we seen some sort of stall? And you can see how the beautiful thing about the thief strategy from John is that, you know, that he's made it such a rule-based thing. So, you know, you could make stuff rule-based. I like to use eyeball, you know, again, I appreciate this because I've got a lot of market experience and screen time. You can do a bit of both, you know, but I like to eyeball stuff and go, hey, how's it looking? Is it stretched? Is participation still there? Do we have volume? Do we have expansion to contraction? You know, you make your own judgments, but the point, you know, to show you John's strategy is that you can systematize it, make it systematic, rule-based. You get the idea. So it is more of a kind of is this then that type of approach. Okay, let's look at version 2. This is, I mean, I think this is less sexy, but you know, I think this as is often the case, this stuff occurs regularly, day in, day out. We've seen it today. And so if you want a bread and butter type strategy to look at, this may be right. If you want something that maybe occurs once every, I'd say, month, if you're lucky, on that stuff, then you've got a way to screen and you look at a daily chart, because how many times you get a decent market, you know, setting up on those daily charts. But worth doing if that's the type of trader you are and you don't want to trade so frequently, fine. Okay, version 2, range bound markets. We know a range bound market, guys, oscillating up and down, testing highs, testing lows, not really breaking out. This is more your classic kind of mean reversion, I think, that most people would visualize in their mind if you were talking about it. And it is way more obviously than over extended days, and you can feel these days, right? And actually the Nasdaq's a perfect example today, isn't it? We've just done pretty much nothing. We've, you know, we've oscillated around that VWAP. Breakouts have failed, hasn't really tried, sell-offs haven't gone very far, and often these come, you know, when we think about, when we identify these, they come before big news days. They come when we're waiting for something. They come when we're in a holding pattern on a daily chart. All these filters you look at on the higher time frame and the macro and go, yeah, you know what? Is there any bolt off to the upside? Probably not. Any reason for it to rug pull? Probably not. My stop's there just in case, but visually I can see that it's doing what I'm expecting to do. locked and loaded. I'm in mean reversion mode. Rotational price action. Ooh, up and down, breathing in and out, expansion, contraction. Bulls are getting a bit of time, bears are getting a bit of time. You get the idea. Now you lock in and you go, hey, mean reversion type of trader. I want to sell highs, buy lows. Whoa, what a genius. Let's make it a little bit more interesting than that. You could sit there and I could get you a chart and say, hey, here's the top, you sell here. Here's the low, you buy here. Well, that's hindsight Harry stuff. You've been in the market long enough in the front line on the trenches to know it doesn't work like that. Now, fine. If you want to sit there and bid at support, then maybe that's going to work out for you. You're probably going to get more trades that way. But I prefer to let the market reject first. And so let's imagine we have a market that's sitting there oscillating around. I want to see it try and break through a key level, try and break through the current low, the prior low, wherever it is, and fail. Because I want to, when I mean reversion, I went back to kind of that initial thinking of price seems more attractive, mean reversion the further away it goes. I need somewhere to structure the stop against. So I want to see the momentum stall. It starts to be like a magnet sucking it back to the mean, wherever that mean might be. And then I'll take it and go, you know what? It's a 2-to-1. I ain't going to bet the farm on this bad boy. But, structurally, there's no reason that this wouldn't work. I've got to stop in place if it does. So you want to see that rejection first. I think that makes much more sense. A couple of examples here, pre-market oscillation on the Dow. You've seen these as a 10 a penny, guys. They ain't going to be the trade of the yield, but it's bread and butter stuff. And again, if your mindset is, I'm in mean reversion mode, I'm thinking about the expansion, and when that kind of Dow starts to rush lower, and you're like, you know what, maybe it's going to break out. I don't know, but actually when it doesn't, and it kind of the spring starts to come back, you go, what's it likely to come back to? It's probably going to come back to that VWAP, but I'm going to wait for it to reject that low first. You just being a bit more smarter about it. Crude oil, rejection of low, kind of mean reverting throughout the afternoon. It's within the prior day's range. No one gives a toss what's going on in this market, this particular chart. Who cares? Nothing's happening. There's no reprice. And so you see the failure test. We'll do more about failures and trap trades specifically next week. But I think that's a much better way of kind of focusing your mean reversion strategy to bracket your range, have your highs, have your lows, see it fail first, see it come back. Then you can take, let's say it fails the high side, you can take your short with the stop above the high, you take your long with the stop below the low. It's easier to not get caught up mentally and going, it's great, it's going to come back. Oh, it's even better, because that's the biggest nemesis of your mean reversion playbook. Okay, so define your range, wait, and you're obviously not getting involved in the middle. You know this by now. Again, this is where we sort of segue into the mindset, the discipline, the mental structure. It's too easy to go, it's gone far enough, it's going to come back to the mean. No, be very precise about what you're looking for. And we always have this balance of precision versus frequency. You can bid at a level and offer at a level and go, I'm just going to take it when the market hits the level. I'm going to take it when the market hits the level. And that's fine. And you're going to get way more trades that way. But I think a more precise way of trading it is to let it fail first. You'll get fewer trades, but I think you get a better stop placement and the efficacy is so much better. Okay, so I wanted to throw some other mean reversion examples that we've covered before. And by the way, if you want to dig into these are on my website. You can go to tradersmastermind.com. There's webinars that we've covered this in depth. VWAP magnet trade. So, if you're looking towards a closing bell, very often the market will revert back to the mean. The mean in that case, if it's been oscillating around a flat VWAP, will be the VWAP. And in the last sort of half an hour, very often it will drift back up. If the Nasdaq is sitting, near away from the VWAP towards the close, I expect it to drift back up towards the VWAP. You need to see price action to kind of support that thesis, but that's one of the things you might do. A lunchbox trade, you heard about this one, you're practicing the lunchtime session, and often it will try to break out the session and come back. That's a good kind of strategy, mean reverting back to the center. A lot of you Forex traders trade the Asian session break and back in, you bracket the Asian session, fails to come back out, back in. This is a different flavor on doing your kind of your own support and resistance levels. This is basically saying it's a structured level. Opening range reversal. So you got the opening range, It's time in a mean reverting environment when nothing's happening, no one cares, daily time frame is not doing much. Very often it might push to break out the opening range and come back in. The point is with these examples is, you know, if you've got your mean reversion hat on, you're saying, I'm looking for mean reversion only. And by the way, I think I tend to prefer this style of trading from a personal level than trend trading. Now, there is you know, if you're kind of taking it up a notch, you can blend this and you can say, hey, this may be the start of something bigger. Am I prepared to cash flow the trade from a mean reversion perspective? Let's say that gold example, you'd be wrong, but in that example, let's say the reversal on gold, you might cash flow it intraday and go, I'm taking some off, I'm going to hold for a bigger unwinding and turn it into maybe a reversal trade, a trend trade, but be prepared to give something back. So there's, you know, there's never black and white, but there's ways to kind of play this. And I think that this is a skill set that's, I think this is one of the best skill sets you can develop. If you can spot turns, if you can spot when the tape just changes, and the tape doesn't necessarily mean, you know, on a very low time frame, just the rhythm's different. I can sense that this is run out of steam, and again, you've got to be on the right place, the right time, the right markets, and looking at the right thing to feel that. Otherwise, a lot of it's noise. Okay, so we've covered a lot of ground today together, and I'm saying, not am I contradicting what I just said a minute ago? And I said this is great. I think everyone should look at mean reversion. I'm not saying trade this. You make your own judgment. You might be way more aligned with trading with the trend that feels right to you. You do that, and maybe you develop this playbook alongside. A good trader should probably be able to do reasonably well on both, but have more of an affinity with one or the other, and it's finding out which that is. So as always, a lot of the problems come when you're trying to fit or use a certain tool for the wrong job. If you're trading mean reversion in a trending environment without waiting for the point where you think it's going to mean revert, you just get run over. You know, and one thing, never trade, because this is a kind of death trap. When you get an intraday trend that's just, you know, as mega trend days you get, that's not a mean reversion. It's out of the window. If you're trading extended trends, you're waiting for the daily, and then you go into the intraday. You're not trading a mean reversion on an intraday. Caveat to that, some of you aggressive scalpers, I don't have a problem with you buying kind of flushes, really panic flushes, and selling them back off on those kind of pops. We had a lot of that during the tariff stuff, where the market would just be like 3 candles down, one final flush. You'd put your market order in there, it'd pop up, you take it out. You wouldn't be looking for, you know, so fine, that's mean reversion, but a very short time frame, and obviously you know, different skill set for that. Respect the context, and when in doubt, just, you know, watch and observe and take notes, stand aside. You don't need to be in every single trade. More than enough opportunity out there to be very clear and very specific about where you're going to deploy your capital. And of course, have a trading plan. All right, we've covered a lot of ground, and I'm on time with 15 minutes. If you've got any questions, you can fire them at me. If I know the answer, I'll give you the answer. If I don't, I will tell you someone or somewhere that absolutely will. And if you want to check out my website, you can do tradersmastermind.com. We've got loads of kind of content on there, and webinar recordings, and you can search for specific stuff. A few articles that we're building out. I've restructured it now. I've got an AI section for traders, all completely free. You know, just grab what you want, what you don't want, discard what you don't want, and join my daily email if you like. And there's also a free discipline tracker on there if you're struggling with discipline. You may well know about that. Again, I don't need to plug that. I don't need to plug, it's free. But yeah, 34,000 people have downloaded that. I will is super interesting. It's going to be more than that. I want to get an update on that. I'm going to find out from and where we are with that. That's a real vanity metric, isn't it? Okay. Thank you, ladies and gents, for your attendance. I'm going to look at these questions. If you've got a question, fire it away. We've got a little bit of time. I want to do these slides, and my 28 slides, man, that's going to be some quick pace. But some miracle seemed to get through it. I don't realize I do talk quick. Some people, I know if English is not your first language, you're probably like, what the hell is this guy on about, man? He is just rabbiting on. Well, fortunately, you get the recording. You can slow me down. I should talk slower, shouldn't I? But I get excited. I love trading, love the markets, guys. I am fortunate to be in the business that is serving very well. Okay, let's go. We've got a bunch of questions here. Nikhil says, hi, thanks for these webinars. You're very welcome. Are there recording slides available? I missed the first session. Cheers. Yes, Nikhil, the recording is sent out. I think Pepperstone sends you a link to the recording a few days after, and then there's a delay. I'm not sure. They kind of leave it quite a bit of time, and then they'll put it up eventually on their YouTube channel. We'll grab it and put it on Traders Mastermind. So if you could check their YouTube channel, if you go on Traders Mastermind arm and grab some more and put some on there, add some context and any downloads and bits that I've maybe talked about there. 18th of April, 2024, you, John Bollinger, Dick Matthews, Ali Crooks, Charlie Burton, Ryan Littlestone, and yes, Greg Brzezinski, I was there too. A great night at Moorgate Place, London. Hey, do you know what? That was it 24? Are you mixing up Royston? Is that not the one we did when I talked about AI? And John Bollinger wasn't at that one, but Charlie Burton, I'm pretty sure was, Ryan Littlestone was, Dick Matthews were. Those guys weren't at the one before where we had John Bollinger. Or maybe it's me not remembering stuff. But yeah, I've done a couple of these now, and they're good fun, man. They're good fun. Good that you were there, pal. Alana, hey, good to hear from you, Alana. Question regarding the mean reversion moves. They can take hours to trigger and often don't trigger at all. Even when I set alerts, I can be sat in front of the screen 1 or 2 hours while it hovers near daily lows before triggering entry. I feel your pain. I don't want to use predetermined orders because I want to see how price moves as we approach the level. Any tips on how to catch the moves without sitting at the screen for hours other than the obvious? It's a tricky one, Alana. The one thing that I did is I made a little indicator, and I'm sure you can get this stuff, which would highlight ignition bars. And so, you can almost set alerts for this and say, hey, once it's gone through a price level, it's going to alert you. And then if you get an ignition bar, it'll alert you as well. So there's ways that you can kind of automate some of these alerts. So what are you kind of looking for? Do I want an ignition bar? Do I want a wide range bar? And that's not going to be perfect. The screen is better if you can. I think it's better to be able to do something else but still monitor it. In the perfect world, still be at the desk and monitor it as close. Maybe you can fine tune it where you go, hang on, can I get it to a point where I get 80% of them with some kind of alert tool that alerts me to ignition bar, or alerts me to a last minute flush, or alerts me to a wide range bar, or something that I go, hey, you know what, something's happening, I need to get in front of the screen and look at it. Oh, wow, some huge questions coming in. Thanks, keep them coming, guys. I will speed through these as much as I can. Must not get stuck on waffling on about things. Okay, great session, Mark. I'm a fan of mean reversion. I like the 61.8% fib retracement. Thank you, Royston. Yeah, I didn't talk about fib. Fib is a good way of structuring stuff. Hello, Mark. Anthony. I never saw an email for recording of the previous week's webinar. Is there a subject line I should look for? I definitely want to rewatch all of these recordings. Thanks. Let me look, mate. Let me look. He says, not going to get distracted by other stuff straight away on Blade browser. You know what? I'll look on my phone. I think I've put it up already, or Armand's put it up on the website already. If you go to Traders Mastermind, may well be up there. Let me look. I'm going to spend 30 seconds. If I can find it in 30 seconds, I'll do it. If I can't. Yeah, it's on. Last one's on there. If you go to Traders Mastermind trading webinars, trend and momentum trading models, it is there. Learning since 1 year liquidity sweeps on higher time frame, market open, wait for displacement on opposite side and trade that. What do you think of that? Learning since liquidity sweep on higher time frame, market open, wait for displacement on opposite side and trade that. Anything, anything where it does one move in one direction comes back. Whether you're calling it liquidity sweep or whether you're calling it a trap. I like that generally. I like the thesis of that. Try and do some business in one direction. Well, not going to happen in reverse. I just like that because it tells you a lot. Kind of you see under the bonnet of the market. You go, hang on a second. It's a little glimpse into what's truly happening. So anything like that, I like. Andy says, Thank you again for your time. It's much appreciated. You're very welcome, Andy. I much appreciate you joining me. How do I tell in real time whether today is a mean reversion day or compression, then breakout day? And says Andy, you can't. Some clues are: what's the higher time frame doing? What's the open? How big is the opening range? We're talking about Nasdaq or Dow. Wide opening range. Be cautious. Does it spend a bit of time doing business above the opening range, below the opening range? What's the overnight range? So if you're talking about Nasdaq, what's the kind of 9 p.m. to 2:30 UK time range? Was that large? What was the kind of price action? Was it trending then reversed? That type of stuff. So some of these clues. One way to do this, Andy, and for everybody, is to find the days that are perfect for you from eyeball or from experience, and then go back and look what the daily chart looked like, what the pre-market looked like, and try and kind of come up with some variables that say, you know what, I think today could be the day that I really take opportunity for, could capitalize on the opportunity. Recommended, Michalis says recommended max percentage risk per day, recommended max percentage risk per week. Personal, mate, it's personal. You know, the textbooks say, you know, you should trade, use 1% per trade. But listen, I've got to be very careful talking about risk because it's a very personal thing. So, you know, ignore me. But if you're learning, you want to learn for as cheaply as possible. And so you want to keep your position size low, 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 low. Let me get tuition and pay as little as possible for it. You can pay the market. The market will take whatever tuition fee you want to pay it. If you've got £250,000, it will say, certainly, here you are, sir. Here's the fee. Write the check. If you've got £500, it will say, yeah, you choose a tuition fee. So if you're learning and you haven't got traction yet, the equity curve's not what you want it to be, just keep stuff as small as you possibly can. However, if you started to show some results, you start to show that things are turning around, you then need to make a decision. And this is a personal thing, and this is a kind of really a separate topic altogether. Do you want to kind of grow? And again, it depends on what account size you've got. If you've got a reasonable account size and you're like, hey, you know what, 20% on this would make a big difference, then great, you adjust it accordingly. Most people don't. Most people have a small account size, and that's fine. And so at some point, you're going to have to say, hey, do I need to risk more than the textbooks say to get the results I want? The answer is probably yes, at the cost of potentially doing damage to the account. So example, you got a £5,000 account. Again, ignore everything I say here. This is just me waffling and waffling in once. You're going to use a small amount. You might be like, well, why am I doing this to make, pennies? But you might say, you know what, I've proven that my strategy is effective. I've proven actually that I can manage risk. There's the right environment, the right time. I'm prepared to risk a little more per trade at the consequence of actually drawing down. And so maybe you go, you know what, do I risk, 10% here? Do I risk 20%? And you might be like, oh, those numbers are extreme. But it depends on what you're trying to do, right? If you've got a smaller account, you're trying to build it into something substantial, at some point, you're probably going to have to do that. But while you're learning, you got to keep it, super, super small. So a very personal thing. There's a long answer for that. I think I've gone into that in depth. There's something I'll cover a bit more because I think it's important. Rowi's in the house. Good to see you, pal. Thank you, Alison, for your feedback. Great stuff as always. Appreciate you, Alison. Thomas says, thank you. Last 2 weeks are really helped me unpack and understand what I've been doing for the last 4 years. This series is the one. Can't wait for next week. See you Thursday. Thomas, thank you, sir. Great stuff as always. Mark, appreciate your feedback. Chris, Xerxes, good stuff, Mark. Reversion has always been my weak spot. This is your time to shine, Xerxes. Rowie, it seems like I'm too early always, but tight stop if it's wide, it sucks. Brad, Mr. Wilkinson, great webinar, mate. Very interesting. Thank you, Brad. Xerxes put the link in there. Appreciate that. I don't know if you guys can see each other on here. I don't even know. Assume you can. Gold has been doing strong mean reversing behavior in the early morning lately, although the daily chart is more trending. Could you still treat it as a mean reversion intraday? No, I wouldn't. Only because I want, if I'm going to trade that, I want to see that the daily is really stretched. Now, could it roll over and just do a normal rollover? Of course it could, any point in time. and then maybe you trade that. Maybe you look at intraday and go, hey, but I'd always want to, from a strictly mean reversion perspective, I want to see it super stretched, almost unsustainable, and then see some weakness to back up, that thesis. What strategy would you suggest for futures, specifically NQ? Bilal. Oh, Bilal, that's a hell of a question. Easy answer for that is, and I know I'm pushing people to my website, but if you go to tradersmastermind.com, I've done trading strategies, trading playbook, day traders playbook, trend trading strategies, mean reverting strategies, opening range breakout. That's Toby Crable's book. That's a good place to start if you're kind of brand spanking new and you want some sort of structure for the NQ. What do you think about prop firms? Vanessa says, thank you so much for his webinars. Recordings are great to go over once again. I appreciate that. Vanessa, I think they play a decent part in the ecosystem. There's some scumbags out there, and you've got to be very, very careful. They're not regulated at the moment. I think they can be useful, but a lot of time I think, you'll hear people spending on challenges. I think you're probably better developing your strategy in a standard cash account, and then going, okay, how do I solve the problem of capital? Marinos says, how does the current gold movement fit with the mean reversion? Gold is very overextended. It is, Marinos, and the way I look at it is this, right? It is overextended, and could it reverse? Yes, it could. Could it struggle at this high and roll back over? Yes, it could, but that would be a different setup. That'd be a different scenario. And I would be very careful about just kind of blindly shorting. I would love to see 1 or 2 days of like, whoa, just rip to the upside, and then the next day weakness. I would just, please. I'm not a religious man. I'm joking. That would be very good. I'd like to see the overextension, and then the day after that to see the weakness. So here, I mean, yeah, could it reverse? Could it kind of do a double top fake out here? It could, and that would be a different strategy that you deploy. Especially if it closes at lows today, maybe follows through tomorrow. Fine, but that's not really kind of. I'd be more focused on an intraday stuff than that, rather than saying, hey, it's fitting on a higher time frame. We've just exploded to the upside, unsustainable. Next day, I want to short what's out of that as soon as I see an opportunity. And you've got to be careful, Marinus, because it looked like it could reverse back when it was sitting in October. Yeah, we kind of pushed up. That could have come back. No way it's going to touch fourth, and it touched 4,000. Oh, it looks like it's going to come. And now we're almost at 4.7, 4.6. So you've got to be careful with that type of approach. I think there's better places to short. So that's why I'm saying I would only look at the kind of a short if I saw a real extension, and that would be brilliant after this run. I don't know if we'll get it. Maybe we do. Good question. Anthony says, hi, Mark, great webinar again. Thanks. Do you ever use VWAP over multi-day period rather than purely based on the daily open and close? If you do you have recommendations on the anchor points? I don't actually, Anthony. That's a good question. I don't. I tend to try to keep it simple of saying, hey, the VWAP's anchored at the open. I use a 24-hour VWAP. Then when the bell goes, I'll anchor it to the open and start to use that more as a reference point rather than the 24 hours. I know there's some people like to use the anchoring at the start of the month, start of the year, start of the week. I think they're points the institutions care about, so those are pretty good. Others like to anchor it at the point the Fed pivoted, or we had a CPI miss, NFP miss. Any of these big points, interesting points where institutions change their assumptions on the valuation of the asset you're trading, that's a pretty good place to anchor it. And I think that's good. I just don't do that. Not because I don't think it's effective. There's loads of stuff I think is effective, but I'm just, I'm doing my one thing and trying to do my one thing very well. Hi, Mark. This is Peter. This is not relevant to the webinar. You did. I'm not going to set your phone number, Peter. Don't worry. You did mention one of your December podcasts that you have a traders hub. I'd love to get it if possible. Yeah, we've just opened this actually. I don't want to plug it and stuff, but I've got a trading community. It was closed for a long period of time because we're focused on building these trading pods. The trading pods worked exceptionally well last year. It was just the best thing that we did. So I said, okay, listen, a few members can join now for the new year, and then we'll do the pods mixing and matching again, and then we'll lock it down again. So if you go to, and the daily email at the bottom of the footer, there's a link and there's a little video explainer there. But I'm not I'm not trying to spread the word on this because I just want a few new members and that's it. And can shut it down, maybe enough for a couple of pods, and that's it. So yeah, just if it's right for you, great. If it's not, fine. You know, it's working super well. Like some of the guys are killing it in these pods. Hi Mark, what do you think of DCA for MR? I'm not sure what that means, Panos. DCA for MR. If it comes to me what you're saying, I'll work it out. 8 o'clock. I know some of you got to go. Fine, no hard feelings. I will get to all of your questions though. What do you think of DCA for MR? Dollar cost averaging for mean reversion. We're talking about mean reversion, and the man's just said it, but he's just been smart. What do I think of dollar cost averaging for mean reversion? Oh, mate, I think that's deadly. I think that's deadly. I like to structure my stops. I like to be aggressive. I like to use my capital as a tool. I like to use leverage where I can, and that just means I feel like I lose control of what I'm doing. Could it play a part of a specific strategy? I think anything can, but if you ask me what I think about it, I think stay away. Panos, Jangir says, good evening, great seminar. Thank you, appreciate you. Mean reversion, can it be used on swing trading or just day trading? Of course, swing trading, Jangir. John Bollinger, those were daily charts that he showed that his thief strategy worked on. So absolutely you can. Gary says, missed most of this session. Oh, Gary, detention for you, pal. We'll watch the replay. Thanks again, as always. Appreciate you, buddy. Yeah, replay should be on the way ASAP. Pamela says, hi, Mark. Thank you for this series. You're very welcome, Pamela. Listening to your experience is very helpful. I used the trend versus momentum lecture in my trading list last week in silver. I made good money, but I still can't hold, even when I have confidence in the trend. As you mentioned, maybe this is to do with my personality and that I don't sleep well if I have an open position. Pamela, I pause you there. No one sleeps well if they've got an open position on silver at the moment. There's no trader out there who's long in silver in size who is getting a decent, nourishing night's sleep, because silver could just do a 5% rug pull the next day. So I'm saying it in jest, but let me finish what you were saying here. Silver moves so quickly. It does. I've learned to keep it small and then increase in size when opportunities develop. It's good to have these sessions because it can feel lonely out there as a trader working from home. Thanks again. Pamela, yeah, in all seriousness, you're quite right. And you preempted what I would say is, you know, if you're trading something like silver that is way more erratic than a grinding up trend, you know, you've got various markets in a kind of grinding up trend, some different stocks out there, what have you. You've got to kind of keep it small, and you've got to accept the fact that, you know, it could stop you out. Now, you know, from a mental perspective, Pamela, and anybody here is, you know, if you're in a trade and you've got an unrealized P&L, here's a trick for you. The real reason we struggle to hold a trade is because we're fearful of giving back the unrealized P&L. Let's use some round numbers, regardless of what these zeros mean to you, with whatever. Let's say you're up $1,000 on a trade, £1,000 on a trade, and you start seeing it come down, but you're worried about giving back that £1,000. So one way to think of it is to go, where's my stop? And to log in this, rather than looking at your blotter, or rather than looking at your trading platform, the broker statements, get a spreadsheet and write down in the trade your entry, your exit, and your exit is where your current stop loss is. And that's the unrealized P&L. And so you only try to lock in on that. So the example would be if silver's ripping to the upside, let's say you're up £5,000, shooting these numbers for argument's sake, right? You don't look at that £5,000. You say, where's my stop? My stop is at the last low, which is £3,000 profit. So now on your spreadsheet, you mark down, I'm up 3,000 on silver. You don't think of the 5, you think of the 3, because that's the worst case scenario. The stop loss is at 3,000. I'm using these numbers kind of, you know, so you kind of season yourself to think, hey, it doesn't matter. Worst case scenario, that's my P&L. I'm up 3. Now, if it goes more and you get to move your stop up, you go around, I'm up 5 now. Maybe you're up 7 in silver. You put your stop at 5K. Okay, I'm up 5. And so you're conditioning your mind thinking, not worrying about giving back the money, because you're not giving anything back. It's irrelevant what the actual real-time price is. You're conditioning yourself to say, hey, that's my stop loss level. That's my profit on the trade. And it can't get worse than that. So that kind of helps you, you know, sit through things. But on another note, Pamela, it may be if you struggle to sleep with stuff, and obviously sleep is super important. It may be that overnight holds aren't really your thing. Maybe you know, or maybe you just need to do it and get more conditioned to it and more and happy with things. There's different ways of approaching this, but yeah, so holding silver overnight is a baptism of fire if you're trying to hold trades. And yeah, Pamela, you may be a good candidate for checking out the premium community if you want to. Again, I'm not, I want to keep it light here. We say Nikkei is currently set up at John Windsor Daily for mean reversion. Obviously, not a trading recommendation. Just a question too, as the structure looks very overstretched. Let's have a look at Nikkei. I looked at it this morning and it wasn't doing what I thought it might do. Oh, it's getting there, John. Yeah, it's getting there. Yeah, it's getting there. I'd want a bit more. I'd want a bit more. Another day. Yeah, maybe. Wide range day, big volume. But there's also one thing to be mindful of. I think there is a catalyst on this that's caused the yen. And what's that new PM's name? I can't remember her name now. But there's something about being quite good for the market. So I'm careful when there's a reprice scenario. But it could start. I mean, if it did like 4 or 5 more days like this, a real stretch, then hell yeah. Yeah, hell yeah. That's the sort of thing you want. You want that real stretch move. Nikkei did something, was it back in 24? We had, that really extended day. Oh, and that was that flush from the panic. Nikkei can be a bit of a spicy one. What tab is TM in the last recording? What tab in TM is the last recording? Webinars. Well, you're asking me the tab. Oh gosh, I should know this. It's my own bloody website. It is resources trading webinars, Chris. Thank you, Paul. Appreciate you. Robbie has a question. The question is already up. Have I missed it, Robbie? Great info as usual. Interested in your pod idea, Richard Stone. Yeah, you know what? I've got a little video that explains it. Richard, have a little look for that. And if you're interested, go for it. And I really try and keep it as accessible as possible, because I know it's tough. Okay, last question. And then we're only 10 minutes over. That's not too bad. And thank you to all those of you who have submitted your questions. I do enjoy answering them. And honestly, the questions are a high caliber. They really are a high caliber. We don't have the questions like, oh, where's the S&P going to close tomorrow? And we have high caliber questions. I like that. That's cool. So let's see. Last question from Rowie. Hey, Mark, I tend to be really, I think I mean good there at fake outs, but after 2 or 3 days I get run over by trend and NQ and do damage to my weekly profit because I try the same idea a few times. Then it turned and my idea is correct. The problem is if a stop is too wide, the risk reward ratio sucks. Rowie, you have to be a little bit more specific. And I know Rowie, guys, he's on these all the time. So I'm talking to him like, you have to be naughty boy, Rowie. I wouldn't talk to anybody like this, but you're a regular Rowie, and you can take this. Be more intentional about what you're trying to achieve with those reversals. Go back, study the times when it worked, study the times when it didn't, and say, hey, listen, why am I getting run over? There's efficacy here. It works, but I'm undoing it with trying to catch too many things. Is there a common theme amongst the trades that work well that I can take forward and use as filters? Or maybe I don't want to do it when the daily is doing this, or maybe I don't want to take it when the market's in this condition. You'll find some sort of filter that keeps you out of the majority of those crappy trades, and so you can play that a bit more. The answer to that question is in your blotter. Somewhere in your blotter, Rowie, is the answers to that. And your job, you don't have to spend ages on it. Your job is to go and find it and look at those, because you'll find some filters. You go, you know what? I'm ruining a good strategy, but I'm polluting it with these nonsense trades. And if I just got rid of some of them, I'm never going to eliminate all of them. And I guided myself a little bit more effectively, then I'd probably come back on top. Oh, wow, there's another bunch of questions. I think these aren't questions, these are all thank yous. Thank you, Richard. Thank you, Chris. Thank you, Richard, you comedian. Where's the S&P closing tomorrow? Kick him out. Cheers, Rowie. Cheers, John Windsor. So name, Sanesh Takachi. Heard it so many times I can't even say it. But anyway, it is what it is. Thank you, ladies and gents. Appreciate you all. We're back in next week talking about trap traders. taking advantage of those who were caught on the wrong side. Would we ever? Would we ever? Yes, we would. Right. See you later, ladies and gents. Appreciate you all. Bye-bye. Take care.